Fellas, you know Degree Cool Rush deodorant, right? Well, last year they changed the formula, and guys were mad about it. One dude even started a petition. So guess what? Degree heard us, admitted they messed up, and brought the original Cool Rush scent back exactly how it was. And it's in Walmart, Target, and other stores now for under $4. So grab some and remember why its cool, crisp, and fresh scent made it the #1 men's antiperspirant for the last decade. Degree Cool Rush is back, and it smells like victory for all of us.
Reality radio for a really great future. We're talking real money.
Watch us change our hats. Ready? Last week we were podcast hosts. Now we're radio hosts. And soon to be podcast hosts again. Like on Monday. Hi, welcome to the radio show that becomes a podcast miraculously. It's called Talking Real Money, listened to by tens of thousands of people all over the Pacific Northwest and around the world.
Huge in Italy.
Yeah, only for that 1 week. I found out I actually went back. Somebody sent me a note and said, what about Poland? Somebody from Poland sent a note saying, well, what about Poland? And I looked it up, and Poland's number 41. 41. Number 1 consistently, long-term.
China.
United States is number 1.
Yeah.
Number 2 is Canada.
China. Oh, Canada.
Number 3, United Kingdom.
Yeah, UK.
Number 4,
China.
Australia.
I'm gonna be right eventually.
Number 5,
China. Okay, thank you. I told you.
Congratulations.
It's like picking the future of the market. Yeah, I'll be right.
And you know, the nice thing is we don't even do it in Mandarin. Nor could we if we even wanted to. Oh, I'm sure we could have it translated, but I don't know Mandarin. Do you know Mandarin?
I know a few words.
We know money. We do know money.
Ni hao. Isn't that like hello?
I don't know.
I think it is. Yeah. That's about it.
We know money. We don't know anything about Mandarin, really, except ni hao, kung pao. I don't know.
Kung pao? Oh, come on. Did you really say kung pao?
Well, I had some last week, and it was really, really good.
Not sure what the direct translation is, but
it means really tasty chicken.
Okay. All right,
it's a little spicy. Hey, we're here to talk about money, and the topic on so many people's minds.
Give the phone number
Given
first.
the week. Oh, yeah. Phone number is 855-935-TALK. I just assume you all know it by now, but there are new people coming on all the time.
Always.
855-935-8255. That is a number for your questions about things going on in the world of money or in your money life, or maybe your money future or your money past or your money woes, whatever it is. We'll talk about them. But anyway, look at last week. Wow. It was not. It's not turning out to be a very good year so far for stocks. So far.
Oh, come on. The S&P 500 is down 3.5%.
Well, it's not good. It's not up.
Yeah, okay. The 100% global portfolios lost a whopping 1%, depending on which global portfolio.
It depends on which global, because
yeah.
I when you say that, people are going to be saying, because we suggest VT a lot.
Yeah, it's down like 4.
Or VT wax.
Yeah, that's because it doesn't have that much small. It doesn't have that much value. It doesn't have that much international value. Emerging market has a little tiny bit in it. Doesn't have as much.
Well, of
if
course.
You're doing it really well.
So it's mainly larger company stocks. Mm-hmm. They do have small company stocks in there.
Not
but they
very
make up
much.
A tiny percentage of the portfolio.
That's the point.
Which is one of the reasons why when we work with our clients, people say, well, why is your portfolio so complicated? Well, because we want to overweight small.
Yeah.
And we want to overweight value. And we want to actually have some emerging markets in there. And this is where, and that's why we're talking about this, because this is where those little differences make a difference.
And over time, they make a difference.
They make a difference because there was a note from somebody last week that said, well, why do you recommend real estate when real estate and stocks move in the same direction? No, they don't always move in exactly the same direction. What we're doing is we're confusing two concepts. There's the concept of assets that don't exactly correlate to one another, that don't move in lockstep with one another, and this concept that doesn't exist of negative correlation. That is, if the stocks, and this is what hedge fund people claim they know. You know, when stocks are going up, we'll be in these because they go up when stocks are going up, or when stocks are going down, but not when they're going up. And
Zigzag.
yeah, the one zigs, the other zags. There's no such thing as one that zigs and the other zags regularly. No, I mean, like right
people
now.
think that's true of stocks and bonds.
Yeah, right now bonds are down too.
Yeah, the intermediate bond I just looked is down about 3% year to date.
Yep.
Okay.
Even my short-term fund.
But here's the thing. People, they see that and then they read Jeremy Grantham talking about the super bubble and the world's coming to an end. And then they, of course, what they want to see is what's next.
What?
That's what they want to know. They
want to know what's next. Yeah.
Yeah, right. Okay. So therefore, what does that equal?
What does it equal? You're supposed to tell us.
Well, I'm going to tell you that Jason Zweig wrote today that 10 years ago, he wrote that people very unrealistically believed the stocks were going to go up 13% a year from that point forward. And he wrote at the time, no, we could maybe make 6 because they've had such a great run. Well, turns out they've made about 13% a year since then. I appreciate his honesty. He also talks about the CAPE analysis and kind of what's next. And then what's next is, nobody knows what's next.
That is the underlying message, and the one that if all of us got this, we wouldn't even have a job. You don't know, you'll not know.
Tom and Don are talking real money.
Is your portfolio a mess? You may have a case of hodgepodgeitis, but don't worry, we can help. Just set up a free, no-obligation meeting with a Vestory advisor at Vestory.com. No sales pitch, guaranteed. That's Vestory.com. Set your course for a great future with a free copy of our 60-page Better Retirement Guidebook at Vestory.com, Vestory.com. A second opinion could save your life either physically or fiscally. Let one of our Vestory advisors help you save your future at Vestory.com, Vestory.com. Tom and I created Vestory to help everyone become a better investor, even those who will never be clients. Let one of our advisors help you start your financial plan or solve a money problem free with no obligation or high-pressure sales pitch at Vestory.com, Vestory.com. Want a free copy of my book, Financial Physics? Well, go download it right now at Vestory.com, Vestory.com.
Your guides to a really great financial future. Tom and Don are talking real money.
What do Tom and Don equal? No, not trouble. Well, yeah, it used to. Now,
I thought you were going to do the weight. Don't do that
don't
on
do
the
that
air.
number.
Good Lord, no.
Money information that is unlike most of the rest, particularly on the radio and podcasts out there, because everybody's trying to tell you what to do now to do better in the future, like they know something they can't know. And that's one of the points we're really trying to get across. If you have a question about the money and the future, and you want to get the truth, you don't want to get lied to, call us at 855-935-TALK. Now, does that always mean we'll have the right answer? No, we're just not going to go out of our way to lie to you. We may have opinions you don't agree with. We may mess up once in a while.
I got to think about what you just said. We won't go out of our way to lie to you.
We
might lie to you, but we won't go out of our way
to you.
All right. Okay.
I mean, like, the Dragon Fund debacle, that whole thing.
Yes. Well, that was a misstatement followed by a
Christina called again yesterday.
Oh, is that right?
Thanking us for the great answer and the correction.
Oh, okay. TDF is also could be known as Target Date Fund, not literally TDF, because TDF, the fund,
Templeton Dragon
not a very
Fund.
good fund. Yeah, that's a bad one. Sorry.
855-935-TALK is our phone number, 855-935-8255. And Kathy, we appreciate your call. Welcome to Talking Real Money.
Hi, Tom and
Hi,
Don.
Kathy.
Thanks for taking my call, and thanks for your show and your podcast. And Tom, I like your jokes. They're just fine, so don't let Don tell you otherwise.
Oh, come
Don't
on.
tell me. I just heard that.
I thought you
He
sounded
goes
like
out of
such
his
a
way.
nice person. And then
He goes out of his way to give me a bad time about him. Thank you.
out of
Kathy.
my way. It's
Yeah, out of
just,
your way.
it's just, I can't help it. All right, Kathy, you can speak anyway.
Okay, so so my question is how much to diversify on the equity side. So there's just so many different buckets. I've been listening to you guys, and I also follow Paul Merriman. And, Paul has a long list, or, his website has a long, great list. And I'm just wondering, how much is enough and how much diversify?
Yeah, I mean, the answer to that is how much work do you want to do? There's a reason that we give a one fund solution, right? The Vanguard Global Total Stock Fund, that
right.
takes in.
Which isn't, as we mentioned in the beginning of the hour, that is not as diversified as we would like to see, but it's simple. It's simple, and that's the key.
We also give two equity funds, one bond fund at our website, talkingrealmoney.com, where we show you one U.S., one international, and one bond fund. You mentioned Paul. I think his has 10 funds. So there you're going to get the money's going to be shifted around a little bit more. So you're going to get a little more small, some value, some of the things you have very, very, very little exposure to in the one or two fund solution. So to me, it's a matter of how much work you want to do. Because if you do the 10, you're pretty well diversified. Although again, we could say, and we wouldn't go out of our way to be not telling you the truth here, we could say that the portfolios that we use for our clients are even still more diversified because they even have a greater tilt to value to small to international parts of the market that even the 10 fund that Paul has is not as much as what we would use.
And the reason we don't suggest it on the show is because of the confines of this program. Most people are out driving. If we went through, and plus it would just be incredibly boring, if we went through a list of, hey, buy these 10 funds, then we need you every year at least, or on average, to rebalance those funds and fight against your own emotions, which will tell you, well, I'm not selling my winners and buying losers. We know that it's so much more complicated than just giving somebody a list of funds and saying, go buy these and rebalance regularly.
Got it. Okay. No, that makes sense. I'm willing to put in some effort. Yeah. For instance, I don't have like small cap blend, or rates, or international small cap and international value. I'm kind of risk
and
averse.
having those is likely to add both, likely over a long period of time. It has in the past, add a little tiny bit of return and reduce the overall volatility of the portfolio. As we said, if you have the kind of portfolio that we create, all equities, it's down less than 2%, while the VT is down over 4%. But the trick is, it's not the work, Kathy. It's the emotional control. And we find a lot of people tell us they have that, and they believe they have that, right up until it's time to make that hard, disciplined decision to do it. Sell my winner and buy my loser. I've got to sell my stocks that made 13% last year and buy those bonds that were down 2%. No, I'm not doing that. See the problem? So,
such a problem, she decided to depart. Yeah, I mean, that is exactly right. The discipline and not just setting things up, but then, as you say, it's counterintuitive a lot of times. You have to sell things that have gone up, appear to be continuing to go up, and buy the ones that have went down. There's that, but there's also the complexity to all of the various sort of funds that we use for our clients. There's just more time, more complexity as well. So it's not as simple, even as simple as Paul's 10 fund portfolio, which I admire.
Oh, absolutely. And we're not saying that in fact, we, if you could do it, good for you.
Yeah, absolutely.
It's just really, really hard in reality for people to do it. And, it almost takes sometimes superhuman effort.
Do you have to be wearing a cape to do it?
Yeah, but different kind of cape. What you want to wear is the cyclically adjusted price to earnings ratio cape.
Oh, yeah. I say that often every day.
That's the cape. The Phil Schiller cape.
Yeah. Which is now trading way above. Oh. The only two times it's traded this high is September 1929, pardon me, and December 1999. Did those two dates ring a bell for you? They're ringing one for me.
I'm actually looking at the S&P 500 cape right now.
And that's pretty high. I mean, so people are saying, are we going to be in this meltdown? Jeremy Grantham recently writing that we're going to have a super bubble.
Yeah, but you know what's funny is that the 1999 CAPE was at about 45.
44.2, it says.
Yeah,
yes.
I'm rounding. And the 29 CAPE was at about 33.
That's 32.6. Yes, okay.
And the current CAPE is, 26. So while it's high...
No, he says it's at 37, by the way, but okay.
I made this chart maybe a little bit older. Yeah, this is probably a little bit older. Okay, so 37 now. But what do you do? Yeah, sure, prices are going to go down.
Here's what you do.
What are you going to do?
What you just do what you just said. You're going to, after things have gone up, you're going to trim them. Mm-hmm. You're going to trim them. You're not going to sell them. You're going to trim them, rebalance the portfolio, and you're going to forget about what's ahead because we'll talk about how Jason Zweig thought he was right and was not here in a moment.
And you can call us at 855-935-TALK, 855-935-8255.
Don are talking real money.
Is your portfolio a mess? You may have a case of hodgepodgeitis, but don't worry, we can help. Just set up a free, no-obligation meeting with a Vestory advisor at Vestory.com. No sales pitch, guaranteed. That's Vestory.com.
For your real life and real future, Tom and Don are talking real money.
I had to rush that phone number because the break was running headlong and I was like, it's like trying to get across a train track when a train's coming. It's like, it's coming, run! I almost got hit. 855-935-TALK is the number. 855-935-8255. Just,
I mentioned again, just to close out this discussion about stocks being in a super bubble. What's next? No one knows, of course. And as I mentioned at the beginning of all this, that Jason Zweig 10 years ago said, there's no way stocks can go up another 13% a year because they just went up 13% a year basically for the prior period. And then they did. And again, he didn't know, and he admits it. I don't know anything. So again, to have the right asset allocation, trim the things that have gone up and ignore all the noise because there's always a lot of it.
And this, I need to add this. That you have to remember that 13% per year that you got over the last decade plus, that is part of the average annual return that we expect over longer periods of time. And that average annual return that even Jason was talking about, the 6, 7, maybe 8% numbers, those are averaged out over decades. So big decades are usually offset by less big. But we don't know how big or how bad or how far or how fast, so you can't play it. It's impossible. Even though you're sitting around going, well, it can't go much higher. Well, it can, and you just don't know when.
Yeah, it's a reflection, of course, of businesses, how well they're doing, what people think the future will be for them. And if I could add one final thing.
No, we're done.
You probably didn't get 13%. Here's why. Because very few of you are 100% in stock.
Yeah.
That's 100% in stock. So there ain't that many of you doing that because there's volatility.
In addition to calling us at 855-935-TALK, you can also send us questions, as way too many of you do, at TalkingRealMoney.com on the contact form. Ladies and gentlemen, I present to you, for the very first time in Talking Real Money history, the first 8-letter question ever posed.
8 letters?
8 letters.
Okay.
Do you count punctuation?
I'm going to give an 8-letter answer then.
No, you don't count punctuation, right?
No, I don't count
Okay,
punctuation.
just letters. Ready?
Yeah. Okay.
No, I didn't include spaces. If you include spaces, it's 10. But I'm not. Are you ready for this question?
Yes,
You're going to love this question.
I hope so.
You
After
are.
this build-up,
oh
I
my
have
gosh.
to.
IVV or VOO? IVV is the iShares S&P 500 fund.
Yeah, right.
And
Or
VOO
VOO.
is the Vanguard S&P 500.
Okay, which one is less expensive? That's the only difference between
They're
the two,
exactly
right?
the same price. Exactly the same
And they're
price.
both exchange traded funds, so there's no
Yes.
cost to buying them.
Correct. If you go to the right broker. Some brokers charge.
Yeah, well, they never do that. Wow.
I have the correct answer. Ready?
Lennerman or Leno. I mean, I don't know what.
Neither. It's not diversified enough.
Well, okay, but if you're looking for an S&P 500
Why are you
fund,
looking for an S&P 500 fund?
Because that's the most important index in the world, Don. It's 500 of the largest U.S. companies.
It's not the best index in the world.
Well,
because
I didn't
it's
say the
only
best. I said most
I
important.
know, but you see, most important people conflate with best.
Yes, they do.
They do.
Yes, they do.
And it's
But
not.
but that could be, you could own that and then own other things.
Yeah, but I say, why bother when you can go get VT for almost the same price? What is VT?
I think we looked that up, and that was like 4 basis points or some ridiculously
I think it's
small
1
number.
basis point more. And instead of 500 stocks, no, it's 5 basis points more.
Oh my goodness, not 5 basis
Sorry,
points.
5 basis points more. But you get small companies, you get internationals, you get all kinds of stuff. I'm not buying this. I'm just no. I think the correct answer is why.
Okay, but I'm going to, just to affirm, if you want to own the S&P 500, I see no difference between those two.
Let's see the portfolio.
They're going to be managed the same way.
Just checking. Yeah,
they have to.
Both have 500 stocks.
Okay.
Oh,
shocker there.
interesting.
The biggest now, I don't even know what the biggest is anymore.
Oh, let me
Tesla?
look. Let me look. No, I don't think it's Tesla anymore. Can it be?
I don't know. It had a big tumble. Is it Apple now or Microsoft maybe? Microsoft hasn't fallen as far as I think some of the other large techs have
Good
been
guess.
beaten
Good.
up.
Wow. Look at how. No, Microsoft's number 2. I'm sorry. I was looking at the wrong
Okay.
thing.
Apple?
Apple is number 1 at 7%.
Okay.
Microsoft is 2 at 6%.
That's
Tesla
13.
is 1, 2, 3, 4. Well, you see, Alphabet doesn't count. Alphabet A and Alphabet C. It's okay, 4%. So Alphabet's second, Amazon, Amazon's Alphabet's third, Amazon's fourth, and Tesla's fifth. There you go.
Tom and Don are talking real money.
At some point, most investors need professional financial guidance. So get a little bit of free help or a lifetime of affordable 100% fiduciary guidance at Vestory.com, Vestory.com.
Reality radio for a really great future. We're talking real money.
Bum, 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 bum. I don't know. What is it?
No. Dun, 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 dun.
Yeah, I don't know. I don't know. I'm trying to protect. Oh, look at you even do percussion.
I could do Howard Cosell if you wanted. Would that be better?
Yeah, you know, there's a
Don McDonald, the former great from New York. No,
If we don't pay the NFL, can we even say Super Bowl?
probably not.
There was like an article I read this morning that said everybody, like some church, Tom, wanted to have some people together to watch.
Oh no,
the Super
no way
Bowl.
you could do that. Yeah, that would be.
And they were going to charge at
licensing
the door.
fee.
They were
Yeah,
going to
how
charge
much?
at the door to cover the food.
Mm-hmm. Oh.
And the NFL wrote them a letter saying, no, you can't do it. Did you know the NFL rules? And I'm sure no one pays any. Have you been into a sports bar where they have like the 900-inch screen?
I've never been to a bar, but okay, yeah. Sure.
Mm-hmm. Well, the NFL's rule is that you cannot show the game on a screen. Tom, this is you.
How much? How
you're
big?
illegal.
How big? Uh-oh.
You
Keep it
cannot
down.
project.
They're going to be
the
knocking
game
on the door. How big?
on a screen bigger than 55 inches.
Oh my God. Well, I guess that's going to. I'll have to watch it upstairs instead of downstairs.
I think the
tomorrow night,
rules are
then.
just a little archaic, aren't they?
Well, but I'll tell you what's not archaic.
What?
Is the ease to bet on the Super Bowl tomorrow. And 31.5 million Americans are betting or going to bet on the game. $7.6 billion with a B.
Mm-hmm.
On that's about an 80% jump from last year. So I don't know. I mean, I guess it's just because it's so easy now.
And let me guess, the people who are guaranteed to profit from this are Oh wait, the sports books.
Oh,
you mean the bookies in the middle?
33 states now have legal sports betting. I thought Washington was one of them, but I wouldn't know how to do it here. I guess there's ways.
Well, I know California isn't. And I think in Florida, the only way you can do it is if you go to a place. You can't do it online. A lot of states allow sports betting, but only a handful. It's like 12 or so allow that online betting, the DraftKings, that kind of thing.
And if it's not exciting enough just to bet on the game where there's a 4-point difference, I guess the Rams of Los Angeles favored by 4 points over the Bengals of Cincinnati. Do you know this? I mean,
no, I don't know this. I don't bet on things.
You can bet on the first person to make a catch. You can bet on the first person to catch it or get a touchdown. And if that's not enough, you can bet on The coin toss?
Well,
Tails never fails,
well,
they
wait.
say.
Okay,
Or
hold on. That's just stupid. If betting,
you got some other places for your money.
If betting is that important to you, why not just, and apparently it's more important than the game, the big game. Why in the heck don't you just sit around your living room and flip coins all night? Okay.
I didn't even get to the fun one.
Tails.
I didn't even get to the really good
That
one,
was
the
the
really
fun
good
one.
bet.
What?
This is the real big bet. The length of the national anthem, over, under, 1 minute, 35 seconds. Which way do you go on that one?
I don't care.
Okay.
It's like the length of the field.
I'm going long, and I'll tell you why I'm going long. I don't even know who the performer is, but when you get out there and you've got all those people and this is big, then you're going to go long because, hey, I'm on center stage. Boom.
Great logic, Mr. Gambler.
Well, we'll see who's right.
My guess is, no, I'm not right. I'm not betting.
Well, no, I'm betting your money. I already put it in there.
I don't bet. I've told you my betting strategy. I have one betting strategy.
Yeah, we're not going to do that because we got somebody waiting.
You go
to
to the
air.
casino and you drink beer and bet until you run out of money, and then you go away. All right, 855-935-TALK is our phone number. Jeffrey, what's up?
Hey, Jeffrey.
Hey, guys. Hey, thanks for taking my call.
Glad to do it.
I've got a bit of a couple of different moving parts here, so I just want to kind of lay it out, and then I might sit back and listen. So looking at buying a house, obviously we got rates doing what we all think is going to be going up over the next 12 to 18 months. Right now, I have about $500,000 in a brokerage account that is going to be the down payment on the new house. I've got about $200,000 of that is long-term capital gains that I will have to pay when I pull that out to make the down payment. And I have about $500,000 of equity in my current house. My question is, I met with my lender the other day, my bank, and I had the opportunity to take the equity in my current house, put that into the brokerage account. So I'd have $1 million in that brokerage account. And then I can take out a line of credit against that brokerage account at the overnight lending rate plus 2.5. My question is, does it make sense for me to hold that $1 million in the brokerage account?
I am just baffled by this advice. Hang on with us a minute. Let us take this break because this is going to take a little while. We'll be back.
Tom and Don are talking real money.
A second opinion could save your life either physically or fiscally. Let one of our Vestory advisors help you save your future at Vestory.com, Vestory.com.
Your guides to a really great financial future. Tom and Don are talking real money.
Howdy, friends. I'm Don. That's Tom. We're moseying down the money range with you here on Talking Real Money. We were talking to Jeffrey, and Jeffrey has $500,000 in his investments. He has $500,000 in equity in his home. Now, before we get into those questions and the advice you got, which I thought was a little strange, let's go backward in time, Jeffrey. Let's go back. How much is this house that you want going to cost?
Let's just call it 1.5.
1.5. Okay. And when are you buying this house?
It'll be in the next 6 months.
Are you going to sell the house that has the $500,000 in equity?
Yes.
Okay. So
just to do some simple math here for me, I mean, again, at $1.5 million, 20% of that would be $300,000 as a down payment. I'm trying to get to why do you need to borrow, et cetera, so much of the money to pay for a home that's $1.5 million?
No worries. Your hook cut me off there a little bit before a couple of data points. The lender on the 30-year jumbo, the best rate I can get is I put down 30%. All right, so I need a 30% down payment. All right.
Okay. All right. Got that. Good.
30.
What would the rate be?
So right now, again, you're great questions. The published rate is 3.5%. Now, if I move over $400,000, I will get an eighth of a point discount. If I move over $800,000, I get an additional eighth. Right, so I get a quarter point off of that rate if I move over $800,000 of new money to this place, which would be the brokerage account, $500,000, plus the cash in the sale of the house If I move those 2 lumps over to this company, I'll get that 1/4 point reduction on the 3.5.
Oh, so this is
They're
like
buying down the rate by
Are
letting
you,
them manage the money.
Yeah,
That's
you're
what they're doing.
managing. They're managing your money for you, correct?
They would. They're not now. They would be,
Yeah.
though, to your point.
Yeah.
Yeah.
And they said they would pay you 2% plus the overnight rate?
No, that's what it cost to
No,
That's what
borrow.
it costs you to borrow. Yeah.
Yeah.
No,
I would take out a lot
this sounds horribly, ridiculously gimmicky. The other thing is why not just do it the old-fashioned way and sell your house and take $400,000 in equity out of that, put that down to get the 3.5% rate, and then invest your other money to hopefully make a lot more than 3.5%.
Well, I was thinking I could make a lot more than the 3 if I didn't use if I put the equity in the house into a brokerage account, had some experts like you guys manage it, that'll get me 8 to 12 over the long haul.
But you're giving them $800,000, so you're where's that money going to go?
They're going to manage it, right? Hopefully, make 8 to 12% on it.
Okay.
But
How are they going to
how
manage
much?
it?
Yeah, how is it going to be managed? Again, here's the reason I don't like these deals, just generally. Because it feels like a kind of a margin-y kind of, like I'm going to borrow against the money that they're managing. There's a complexity.
It sounds
right?
gimmicky, too.
It just, I would rather see you, and by the way, there'd be places you could go buy down the loan without it being this complicated if you really had to. But even at 3.5%, that's still pretty cheap money if you look at the long haul, Jeffrey. So I would still rather see the 3.5, keep your money, put the 20 or maybe 30% down if that's what's going to be required because you have the cash. Take the rest of it, invest it at a much lower cost probably than what these people are going to charge you. I'm just guessing because of what they want to charge you for the line of credit to do all of this. I would rather see it that way.
Have you shopped rates?
I have not shopped rates. My call to you guys was to ask this complicated question.
Yeah, I don't like this deal. I don't like it. I don't like it. Are you a Costco member?
I am not a Costco member. I don't have my current house is not big enough to have a Costco membership. My next house.
Okay.
Good for you for knowing that.
I was just
too,
trying
by
to
the way.
save you some money because Costco does some deals on mortgages, but I'm looking online right now, and I'm looking at rates of 3.25%, 3 1/3.
Yeah, it's somewhere around 3.5. I think
I
for
would go
30.
shopping, and I don't think, and these are with 20% down.
Remember,
No
this is a
gimmicks.
jumbo. Might be
That's
a
what I'm
little
saying.
more
These are
with the
jumbo rates. No,
Oh,
I
okay.
pulled up jumbo rates. I got jumbo rates. Wow. I'd shop. I'm not. These guys aren't. They're not passing my smell test. I'm not
Me
feeling
either
good
with
about
those
them.
rates.
I'm not feeling
No.
good.
And it's just
855
complicated.
Yeah, 855-935-TALK. That's it. It sounds so. And generally, when a deal is complicated, it is bad. Almost always, the more complex the deal, the worse it is, because they use complexity to reduce transparency, to add opacity. It's
generally expensive, not just bad, more expensive generally.
No, I would run away. Scott, you're up next. Welcome to Talking Real Money.
Hi. I have a question. I don't know. It might be a silly question. Why, when interest rates goes up, does the value of your bond go down? I would think that if you buy something, it would stay. The value would stay the same.
Here's a simple explanation, by the way. When rates go, let's just say you hold a 10-year bond that has a coupon, a yield of 1.5. And then tomorrow, a new bond for that same period of time is sold with a higher rate of 2%. Your bond's not worth as much. So that price, therefore, that comes down. I mean, so the two are really fixed at the hip.
It's really simple. Look at it this way. If the rate one day was 1.5 and you bought a 10-year bond that day, 1.5, the next day the rate jumped, which it wouldn't, to 2%. That's 25% more income from the bond. To get your bond to yield 2% total, you have to reduce the price by about 25%.
Pretty substantial difference there. So, yeah, they are directly related. There's no question.
Does that help?
Yeah, a little bit. I was just curious because I listened
your
to
bond.
one of
Your
podcasts
bond has
and
a
said
fixed. Your bond has a fixed rate of return. When you buy the bond, that rate is fixed for the term of the bond. It doesn't adjust up or down. So when rates rise, your return is still going to stay low, which is one of the reasons why we suggest bond funds, short intermediate term bond funds for people, because there, the rate of the bonds that are coming into the portfolio are gradually rising, even though the value of the bonds they already own have gone down. So eventually, over time, things kind of balance out. But it's always the inverse. If interest rates rise, the value of an old security at a lower rate is going to go down.
You had a follow-up question to that, Scott, or does that help?
So you're not really losing money. You're not losing value as far as you put in, say, $10,000. It doesn't go down. Your $10,000 is still there.
You got it. Yeah. Okay. So there you go.
Perfect.
You did it. Now, if you bought a $10,000 bond yielding 1.5% and it matured in 10 years and you held that bond for the full 10 years, you will get your $10,000 back. It's only if you want to sell it early that you have to sell it to somebody else at a discount.
Okay. That makes more sense.
Okay.
Yeah, and
thank you.
People don't know that. Thank you for the call. People don't realize that the bond, I think this is still true, the amount of trades in the bond market are actually greater on a dollar basis than they are with stocks. You just don't hear about them as much.
No, because there's a lot of stuff going on, but it's only with a very few bonds by comparison when you compare with stocks.
You hit the nail on the head. Bond fund diversification. Bond fund diversification of rates and bond fund. You can get them at very low cost. So it's a great alternative, Don.
Our phone number is 855-935-TALK. Call us anytime at that number.
Tom and Don are talking real money.
Tom and I created Vestory to help everyone become a better investor, even those who will never be clients. Let one of our advisors help you start your financial plan or solve a money problem free with no obligation or high-pressure sales pitch at Vestory.com. Vestory.com.
For your real life and real future, Tom and Don are talking real money.
You know, we help a lot of people on this show and this podcast, but we also help you in some ways that you may not be aware of.
Well, tomorrow's Super Bowl Sunday. It's time to raise your game. Get the help you need. You like that? Okay. Anyway, yeah, we
see, now you
have
sound
conversations
like a commercial.
We have conversations regularly with people that want our help one-on-one. They are absolutely free. There is no obligation, and I will make a guarantee. You will walk out of that meeting with things you had not thought of. No question.
And if it was an ad, you have to say the big game.
The big game.
Tomorrow is the big game.
Thank you. I got to pay for that one, right?
If you would like to get this help that Tom's talking about, just go to Vestory.com. Okay, that's our website. Set up an appointment there, Vestory.com.
We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately and consistently predict the future, so past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial product or securities. Instead, the program is provided as a public service by Appella Capital, a fee-only registered investment advisor. Thanks for listening, and please visit TalkingRealMoney.com for more information and disclosures. To keep the lawyers happy.